Most people say it's impossible to invest in high school or college. During my first year of working at 16 years old, making minimum wage, I maxed out my Roth IRA at $7,000. Today, I'm showing you the exact portfolio I used to grow that $7,000 to $10,000 and why I chose specific ETFs over the popular ones or popular individual stocks. I'll also tell you how I contribute to it even when I can't. If I can do this on a student budget and making even less than minimum wage, I think you can too. I just want to make a disclaimer that I'm not a financial advisor. In this video, I'm just showing what I've been doing the past few years to build my portfolio, and I'm just sharing my journey with y'all. First off, I think it's important to note that I use Fidelity as my brokerage. Not really any specific reason, just that my parents started it for me while I was in high school, so it's the one that I started to use. It's not that difficult to learn, but it kind of is a little older in terms of UI. I also use SoFi as an individual brokerage, and it's a lot better in terms of UI, but there's pros and cons to different kinds of brokerage institutions. So for my Roth IRA, I only have ETFs. First of all, Roth IRA stands for Individual Retirement Account. You can contribute to this starting whenever you work, and you can basically max it out up to $7,000 per year and invest in stocks or ETFs, and it's just going to keep compounding until you retire and take those funds out. There's also like 401ks, individual brokerages, but in this video I'm just going to talk about my Roth IRA, which is my retirement account, and I've started it when I was 16 years old. In this account, I only have ETFs. I recommend this over stocks because ETFs provide diversification over multiple companies. They are basically funds where it's a pool of companies. So like there's some where it's tech fund, and there might be like Google, Meta, Nvidia, big companies like that that make up percentages of that fund. It really just lowers your risk and it's less volatile compared to those individual stocks, because any day Microsoft can just go all the way up or all the way down, and it's risky. ETFs, they grow slowly every year, but and you can trust that it's just going to keep going up most of the time. They're a tool that allows you to capture the growth of multiple sectors like tech, healthcare, finance, or the total stock market without needing to constantly monitor it every day to see the volatility. You don't even gotta like check the news to see if your Google stocks can go up or down the next day. As a student, this gives you a high return on investment while protecting your capital, while also having that long-term compound interest of the world's most successful businesses. As you see in this video, you will earn money from, we call it dividends. You're going to earn money from those dividends and you're going to reinvest in the stock, and it's just going to keep like a snowball effect. It's just going to keep going down that mountain and compiling with more snow. I used to have a primarily stock Roth portfolio, and I learned that it's not the best way to invest in your Roth. I learned it wasn't the best way because any day the market could just dip, because I had some Amazon stocks, Nvidia, any day it could just dip. So I reallocated my portfolio in February of this year, and it's completely tax-free to do that. Since then, my growth has all been green. There hasn't been red. It hasn't dipped. If you've seen those popular ETFs lists online, that's a good place to start, but I'm going to show you the metrics behind my portfolio. First up is the S&P 500, and this is basically America's top 500 companies, and it's always changing. Companies can drop out at any given notice, and they'll bring in a new company in that is in the top 500. Most people buy SPY, VOO, IVV, or SPLG. Since I have Fidelity, I got FXAIX, and that's a Fidelity option because it has a low expense ratio, meaning I keep more money into my pocket when I buy this one. A low expense ratio basically means that you pay a smaller percentage of your investment into the funds managers each year. It allows more of your money to stay invested and grow through compound interest. Most of my portfolio is in this S&P 500 fund at around 45%. The next ETF I have is an aggressive growth ETF, and I use SCHG. Why? This is basically an ETF that tracks the fastest growing companies in the US stock market, primarily within the technology and consumer services sectors. It targets those companies with a strong growth potential rather than tracking dividends. Because it has a very low expense ratio, it's a high return on investment alternative to more expensive tech funds. So long term, you're going to have maximize gains. You're gonna have bigger gains than other kinds of ETFs. And I have around 15% of my portfolio in this ETF. Next is my high dividend yield ETF, and I use SCHD. This ETF is a combination of 100 of the biggest, most financially stable US companies that have a track record of paying high dividends to their stockholders. You want a higher dividend yield because that means you're going to get more dividends when it's paid out. It's going to allow you to reinvest into more shares and accelerate your growth and compound interest without you having to spend another cent. It essentially provides a passive income stream that keeps your portfolio growing even when the market downturns. And I have around 15% of my portfolio in this ETF. My next one is tech. I use VGT because it provides an exposure to the giants in the IT sector like Microsoft and Apple. These are like primary drivers of market growth these days, so it's an important one. Now, this is essential for a high school and college student's portfolio because these tech companies are going to have high earnings per share and massive potential to boom within the upcoming years as they lead the AI and software era. Adding this ensures that you're not just tracking the economy, but investing in a specific financial sector that's reshaping the global financial landscape of the 2020s. I have around 10% of my portfolio in this ETF. Next is my international ETF, and I chose VXUS because it provides exposure to over 8,000 international companies across Europe and Asia. This ensures that I'm not solely dependent on the US economy for my Roth IRA. It allows me to capture growth from global giants like Nestle, Toyota, that the US only portfolio would completely miss. It really diversifies your Roth IRA, and I have around 10% of my portfolio in VXUS. And finally, our US small companies. I added AVUV to my portfolio. Now, this some people might overlook, but I'm betting on the underdogs, which are these smaller, highly profitable US companies that have way more room for growth than big tech giants. They have more boom potential than these companies that are already worth trillions of dollars. And by putting 5% into this fund, I'm positioning myself to capture higher historical returns of small value stocks, which would give my portfolio an extra edge that the popular S&P 500 funds alone can't provide. Once again, 5% of my portfolio is in this ETF. So why does this portfolio work for me? It's all about the fundamentals. Like I mentioned before, but I want to mention again, these are important when selecting ETFs and stocks for when you have an individual account. Your dividend yield, you want a higher dividend yield because these companies will basically pay you to own them. You could also set these to DRIP, which is a dividend reinvestment plan. So your dividends automatically reinvest into more shares, which creates the snowball effect. That way, it's just not just sitting in your account collecting dust as cash. If you want a higher earnings per share, I look for companies with rising earnings per share because if your earnings are growing, that means the stock price is eventually going to grow as well. Finally, you also want investments that will be good to your portfolio health. You can see here that since reallocating my Roth, I'm up 10.4% on FXIX and nearly 9% on VGT and AVUV. That isn't luck, that's choosing high quality funds that balance the tech growth with the small cap value. Now, if my invest in Roth IRA talk hasn't convinced you yet, let's look at the actual math. On the screen now is a Roth IRA calculator because I want you to see the return on investment of starting at 18 years old versus waiting until you're settled into your career. We're going to look at three different scenarios. The first scenario is starting at age 16. The annual contribution is about $1,200, which is about $100 per month, with an expected return rate of 10%. This is an average S&P 500 return, and I'm going to use it for all three scenarios. Now look at this. If you start at 16 with just $100 a month and you never touch it, by the time you're 65 years old and ready to retire, you're looking at over $1.2 million. You barely felt that $100, but the compound interest did all that heavy lifting for you. Scenario 2, you're starting at 18 years old with an annual contribution of the max $7,000, which is $583 per month, with the expected return rate at 10%. This is what I'm trying to do right now. By maxing out my Roth starting at 18, the calculator shows that you'll have $6 million at retirement tax-free. And lastly, the third scenario is starting at age 22 with a maxed out contribution as well at 10%. Now notice the difference. By waiting just 4 years from 18 to 22 years old, the length of a standard degree, you end up at about $4 million. These are 4 years of just waiting that costs you $1.9 million. Now, this is a massive loss on your lifetime return on investment, but if you are 22, it's never too late. Guys, if there's anything that you took away from this video, is investing is the best way to ensure your future. Just start with $15 a month if you can. Just start today. Just put some money in there. I know we're high school and college students, so sometimes it's hard. We have tuition to pay. We got bills to pay. We have to also enjoy ourselves, but just try to put in something in there. Thank you guys for watching this video, and let me know in the comments below if you want more high school or college investing or finance tips. I like making these. I'm passionate about it, and I'll see you in the next one.